There is a financial product in America that you are encouraged to take on at 17 or 18 years old, before you have any meaningful income, before you've ever read a loan document in your life, before you have any real understanding of compound interest, and before you have any idea what job you're going to have in 4 years. A product you take on in the largest amount most people will ever borrow outside of a mortgage. A product that, uniquely among all other forms of debt in America, you cannot discharge in bankruptcy no matter how badly things go. A product that starts accruing interest the moment it is disbursed, sometimes before you've attended a single class. And a product that, in many cases, is sold to you by the very institution that directly benefits from you taking on as much of it as possible. If I described that product to you without telling you what it was, you would assume it was illegal. You would assume some regulatory body had shut it down. You would assume there was a class action lawsuit that paid out $3 and a coupon. But it's not illegal, it's not shut down, it's federal policy. And it has produced $1.7 trillion in outstanding debt, owed by 45 million Americans, many of whom are going to be paying it back for the rest of their working lives. I'm talking about the student loan system, and by the end of this video, I want you to understand not just that it's broken, but exactly how it got broken, and exactly who designed it this way. Let's start in 1958. The Cold War is at peak anxiety. The Soviet Union just launched Sputnik, Congress is panicking, and the United States government decides it needs more scientists and engineers, fast. So, Congress passes the National Defense Education Act, which for the first time creates a federal student loan program. The purpose is narrow, strategic: get more STEM graduates, keep up with the Soviets. And it works fine for a while because the program is limited, the loans are modest, and crucially, the federal government is not yet in the business of guaranteeing private lenders against default risk. That changes in 1965. President Lyndon Johnson signs the Higher Education Act, which massively expands access to federal student loans and, more importantly, introduces federal guarantees for private lenders, meaning if a student defaults, the federal government makes the lender whole. And if you are a private lender and someone just told you that you can issue loans with zero default risk because the government will bail you out if anything goes wrong, what do? You issue as many loans as possible, as large as possible, to as many people as possible, because the downside doesn't exist for you anymore. The downside now belongs to the taxpayer and to the 18-year-old who just signed the paperwork. Which brings us to the first thing nobody talks about. When you remove default risk from a lender, you also remove the lender's incentive to care whether the loan makes sense. In normal lending, a bank lends you money because they've evaluated whether you can pay it back. If they're wrong, they lose money. That feedback mechanism is why banks don't normally hand a $100,000 loan to someone with no income, no credit history, and no collateral. The fear of being wrong keeps them honest. Student loans, especially federal student loans, have no such mechanism. The federal government does not evaluate whether your specific degree from your specific institution at your specific price point is likely to produce enough income to repay the loan. It just disperses the money to anyone, for any degree, at any school, at any price. And the school doesn't bear any meaningful consequence if you graduate with $80,000 in debt and can't find a job. They already got paid. The loan was disbursed before you walked into your first lecture. The incentives in this system are so perfectly misaligned that if you designed it from scratch as a mechanism to extract money from young people, you would design it exactly like this. In 1980, the average annual cost of a 4-year public university was roughly $3,500. By 2023, it's over $27,000. That's more than a 670% real increase. For context, general inflation over the same period was around 200%. Healthcare, which everyone agrees is catastrophically expensive, increased around 600% over the same period. Tuition beat healthcare inflation. Let that sink in for a second. And the reason is not a mystery. It is a direct consequence of what economists call the Bennett hypothesis, named after a former Secretary of Education who warned about it in 1987. The basic idea is simple. When the federal government makes more loan money available to students, universities raise their prices to capture it. Because why wouldn't they? the student's ability to pay is no longer constrained by their income or their family's savings. It's constrained by how much the federal government will lend, and the federal government will lend a lot. So universities just keep raising prices to meet the available funding. It's not predatory in an illegal sense. It's just rational from the university's perspective, which is exactly the problem. And I want to be specific about where the money went. Because when tuition went up 670%, did professor salaries go up 670%? No. Did the quality of undergraduate education improve by some measurable 670%? Not according to any research. What did go up is administrative staffing. In 1975, American universities employed roughly equal numbers of administrators and faculty. By 2008, administrators outnumbered faculty by a factor of 2 to 1. The number of administrators at universities increased by 240% between 1975 and 2008, 10 times the rate of enrollment growth. 10 times. And administrators are expensive. They require offices, support staff, and salaries that have grown considerably faster than faculty pay. And lazy rivers, apparently, because somewhere along the line, universities decided that luxury recreation facilities were a legitimate enrollment strategy. You now have universities with climbing walls, lazy rivers, gourmet dining, and hotel-quality dormitories, all funded by student tuition, all justified by the competition for enrollment. It's an arms race paid for entirely by people who are 18 years old and borrowing money to be there. And the list just keeps going. Meet Brittany. Brittany is 22. She just graduated with a degree in communications from a mid-tier private university and $68,000 in student loans at an average interest rate of 6.5%. She got a job at a marketing agency making $42,000 a year, which felt like a victory, because her friends with English degrees are still looking. Her monthly student loan payment on a standard 10-year plan is about $770. That's roughly 22% of her take-home pay, before rent, food, transportation, or anything else that makes human life function. So, Brittany enrolls in an income-driven repayment plan, which reduces her monthly payment to something manageable, around $280. And she breathes a sigh of relief. What Brittany does not fully understand is that $280 a month does not cover the monthly interest accruing on her $68,000 balance. Her loan is growing while she's making payments. In year 3 of making payments, Brittany's balance is higher than it was when she graduated. She did everything right. She graduated, she got a job, she enrolled in the repayment program. She is making payments every single month. Her balance is going up. And that is not a bug. That is how the system was designed to work. Which brings us to the part that should make you genuinely angry. Because the income-driven repayment plans that the government offers as the humane alternative to crushing monthly payments come with a promise. After 20 or 25 years of payments, any remaining balance is forgiven. And that sounds great, except for 2 things. First, the forgiven balance was, until very recently, taxable as income in the year it was forgiven. Meaning, if you made 25 years of payments and your forgiven balance was $45,000, the IRS would send you a tax bill treating that $45,000 as income. In a year when you just paid off your student loans and have no extra money. Second, the forgiveness programs have had a catastrophic administrative failure rate. The Public Service Loan Forgiveness Program, which promises forgiveness after 10 years of payments for people working in government or nonprofits, was created in 2007. The first wave of eligible borrowers applied for forgiveness in 2017. The approval rate in that first year was 1.1%, not 11%, 1.1%. 99 out of 100 people who thought they were on track for forgiveness were rejected, usually because of paperwork errors, wrong loan types, or wrong repayment plans that nobody told them about when they enrolled. The program designed to make student loans manageable for public servants had a 98.9% rejection rate, and the loan servicers who were supposed to guide borrowers through the process were being paid per account managed, not per successful outcome. So their incentive to make sure borrowers were in the right plan for forgiveness was exactly 0. And this is a good moment to talk about the loan servicers, because they are a critical piece of this whole architecture that most people have never thought about. Federal student loans are issued by the government, but they're serviced, meaning managed and collected, by private companies. Companies like Navient, which until 2021 was the largest student loan servicer in the country, managing over $300 billion in loans. And in 2017, the Consumer Financial Protection Bureau sued Navient for, among other things, steering borrowers into forbearance instead of income-driven repayment plans, even when income-driven repayment was clearly better for the borrower. Why would a servicer do that? Because in forbearance, payments pause, but interest keeps accruing, and a larger balance means more interest, and more interest means more revenue for the servicer. Navient eventually settled for $1.85 billion and canceled $1.7 billion in private loan balances. They admitted no wrongdoing. The borrowers who were steered into unnecessary forbearance during critical years of their repayment, they got a letter in the mail, and their balances were still larger than they should have been. Because I want to talk about the bankruptcy thing, because this is the detail that separates student loans from every other form of debt in America. In 1976, Congress amended the Bankruptcy Code to make federally issued student loans non-dischargeable in bankruptcy, except in cases of extreme hardship. In 1984, private student loans were added to the same restriction. The justification was that young people might take out massive loans, immediately declare bankruptcy to discharge them, and then go on to earn high incomes without ever repaying. Which sounds reasonable until you look at the data, because there was no evidence that this was actually happening at any meaningful scale. The bankruptcy exemption was a solution to a theoretical problem that wasn't really occurring, but it had a very real effect on the incentives in the lending market. Because when you tell private lenders that their loans cannot be discharged in bankruptcy, you have just made student loans the most risk-free private lending product that has ever existed. You cannot go bankrupt out of them. You cannot die out of them in most cases, because many private loans have co-signers. There is no exit. The only way out is to pay, and if you can't pay, you stay in the system indefinitely, accruing interest, being reported to credit bureaus, and watching your balance grow, which is a perfectly fine outcome if you're a lender, which is exactly why it got designed this way. And the people who lobbied hardest to keep student loans non-dischargeable in bankruptcy were, unsurprisingly, the private student loan industry. Sallie Mae, originally a government-sponsored entity, spent years lobbying Congress and eventually became a fully private company in 2004, rebranding as Navient and SLM Corporation, with a stock market listing and shareholders to answer to. When Sallie Mae was lobbying to keep private student loans exempt from bankruptcy discharge in 2005, their CEO compensation was in the tens of millions annually. The company was profitable because the loans were inescapable. Take away the bankruptcy exemption and the whole business model gets riskier, which means you lend less recklessly, which means you make less money. So they lobbied hard and they won. And the 18-year-old signing the loan documents in the financial aid office had absolutely no lobbyist at the table, which is, in one sentence, how American financial policy gets made. Here's the number that puts all of this in perspective. Total outstanding student loan debt in the United States is approximately $1.7 trillion. That is more than total outstanding credit card debt. It is more than total outstanding auto loan debt. It is the second largest category of consumer debt in America after mortgages. And unlike mortgage debt, it is not secured by an asset that can be sold. When a homeowner can't pay their mortgage, the bank repossesses a house that has value. When a student can't pay their student loans, the loan servicer repossesses nothing because a diploma is not collateral. The value of the education may or may not materialize in the borrower's earnings. If it doesn't, the debt remains anyway, indefinitely. This is not how any responsible lending framework is supposed to work. And yet, this is the framework that 45 million Americans are currently inside. Because the student debt burden isn't spread evenly across income levels or across time. The people most likely to carry the most debt are the people who went to the most expensive schools or who didn't finish their degrees. Roughly 40% of students who enroll in a 4-year college don't finish within 6 years. They drop out. With the debt, but without the degree. Without the diploma, that was the whole justification for taking on the debt in the first place. And this group, the borrowers without degrees, have the highest default rates and the worst financial outcomes. They took the risk of the loan. They didn't get the reward of the credential. And the system has no mechanism to acknowledge that this happened. The loan doesn't care that you didn't graduate. It just keeps accruing interest. And the downstream consequences of $1.7 trillion in student debt aren't abstract. They show up in the data in very specific ways. Americans with significant student debt are buying homes later, or not at all, because the debt affects their debt-to-income ratio and their ability to save for a down payment. They are delaying marriage. They are delaying having children. They are starting businesses at lower rates than previous generations because you can't take entrepreneurial risk when your fixed monthly debt obligation is 3 figures before you've paid rent. The economic activity that doesn't happen because of student debt is enormous. Every dollar spent servicing a student loan is a dollar not spent in the broader economy. And the Federal Reserve Bank of New York has estimated that the student debt burden has suppressed homeownership rates among young adults by measurable amounts, which has knock-on effects for the construction industry, for home goods, for the entire housing ecosystem. It is a weight on the economy, not just on the individuals carrying it. And the system keeps producing more of it every single year because 18-year-olds keep turning 18, keep being told that college is the only path to a good life, keep walking into financial aid offices, and keep signing documents that nobody has properly explained to them. So, what actually needs to change? And I want to be clear that I'm not just here to tell you the system is broken and then wave goodbye, because there are real structural fixes that people argue about and that have very different implications. The most politically visible one is loan forgiveness. And the argument is simple. The debt was predatory. The borrowers were misled about outcomes. The bankruptcy exemption was unjust. So cancel the debt. The counter-argument is also simple. It doesn't fix the system. If you cancel $1.7 trillion in student debt tomorrow and don't change the underlying incentives, tuition will keep rising. The next generation will take on the next $1.7 trillion, and in 15 years, we're having this conversation again. Forgiveness treats the symptom, not the disease. The structural fix that makes more economic sense is making the federal government and universities share in the downside. If universities had to repay a percentage of federal loans that defaulted, they would immediately become very interested in whether graduates were getting jobs that could support repayment. Right now, universities have zero skin in the game. They get paid up front. What happens to you after graduation is not their problem. Change that single incentive and you restructure the entire relationship between tuition, academic programs, and economic outcomes. The other structural fix is restoring bankruptcy protection. If private student loans could be discharged in bankruptcy like virtually every other form of private debt, lenders would immediately start evaluating whether loans were likely to be repaid. They would stop issuing $100,000 in loans to a student studying at an institution with poor graduation rates and worse employment outcomes. The market would self-correct. The access to unlimited non-dischargeable private credit is what allows the entire overpriced machine to keep running. Take that away, and the machine has to slow down. None of this is happening fast. None of it is happening soon. Because the people who benefit from the current system are the same people who write the checks to the same people who write the laws, which is a pattern that repeats so often in American finance that it almost feels boring to point out. Almost. Here's where I land on all of this. The student loan system is not a conspiracy. Nobody sat in a room and said, let's design a trap for 18-year-olds. What happened is more mundane and more infuriating than that. A series of individually rational decisions by universities, lenders, servicers, and policymakers added up to a system that is catastrophically irrational in aggregate. Universities raised prices because they could. Lenders issued more debt because the risk was federally guaranteed. Servicers steered borrowers into worse options because it was more profitable. Policymakers preserved the bankruptcy exemption because lobbyists paid them to. And 45 million borrowers ended up inside a system, and the 22-year-old with $68,000 in debt and a $280 monthly payment that doesn't even cover the interest got handed the tab for all of those individually rational decisions, which is a machine that turns the financial anxiety of teenagers into a decades-long revenue stream. And the admission office brochure has really good photography. So I want to hear where you land. Do you think loan forgiveness is the answer? Do you think the fix is making universities share the risk? Or do you think this whole thing was always going to end this way the second someone decided to hand 18-year-olds unlimited non-dischargeable debt and call it opportunity? Drop your take in the comments. Because this one's going to get interesting.